entry and risk management. By way of starting, I want to first of all say thank you, Mr. Ezra, for this opportunity to share with the team as a free way of giving back to the society. Thank you so much. It's an honor to be here. Basically, as a forex trader, there are three areas I like concentrating on. That's my idea. That's what I believe is personal to me, and that's what I think every one of us should also look into. First, you want to consider knowing structure. These are the three areas I feel is most important. First is your structure. You must have a solid knowledge of structure because that's the pattern in which the market runs. That's the formation in which market is programmed or designed to run. Then the second most important thing I want every trader to know, or I would love every trader to focus on, is liquidity. And that's what we're looking at tonight. And after liquidity, in my opinion, entry becomes the next um, aspect coupled with risk management. You can't talk about entry without talking about risk management because we want to ensure we get a tighter stop loss that will not make us um, um, open more or make our account to be at risk per time, per trade. So our boss has taken us through structure yesterday, and there are materials in his YouTube page that deals very well on structure. Then tonight I'll speak about liquidity. What is liquidity? Um, just a simple definition, liquidity means money. Liquidity means money. There's no other definition to it. Liquidity means money. The volume of orders in the market. That's liquidity for you. So in here of liquidity, we're not don't take it as maybe a big word or something. No, liquidity simply means the volume of orders that is in the market per time. So liquidity is money. Stop losses. Like if you put a position, for instance, and then let's say we are bullish, and then price comes, give you this high. This is when a trend has been established because you have a high, you have a low, you have a higher high. So immediately price starts retracing. What it means is that people are already selling at this point. That's what brings about retracement. People are already selling at this point. Don't assume the market is just moving. People are already selling. That's why this retracement is here. It then means that as people are selling here, somewhere above their entry, they will have their stop losses around that zone. Somewhere above their entry, they have their stop losses around that zone. So they have entry here, they have stop losses here, stop losses above. Then price comes and give you maybe a push up and pushes down. It means that more sellers have entered into the market from this region, and probably they have their stop losses around this zone. So all those areas are what we call money is rested in these zones, all these zones. Orders are here, monies in the market are rested in all of this zone, zone 1, zone 2. So most time what price will do is that price is always attracted to where money is. They want to come either to take you out and then come back and push downward. Why would they want to take you out? They want to take your orders close at your position, because if you are selling, for instance, you are only telling the market, okay, if price keeps going down, let my position keep running. But one price goes above this stop loss, above this position, close me out of the trade. And the price goes down, smart people will take some profit from here. Price retraces. More sellers hop into the market, having their stop losses at this place or having their stop losses at these highs, depending on how you were taught. And then price keeps going down. And you know that once this leg has been formed and the second leg has been formed, this is like a confirmation for more sellers to hop into the market. So as price was coming in this direction, people will think that okay, price is going to bounce off this level. More sellers jump in from here, and then price just kicks them off. More sellers jump in here, having their stop losses above the highs also. Then price comes, takes everybody out and goes your way. So this is what we call liquidity. Smart money is simply trying to establish, fill in their own position. So they need your money. They pick your orders, close you out, and price will still go the intended direction. So that's why the concept of liquidity is very important. You want to know, you want to be able to predict, or should I call it predict? You want to be able to assume what the banks want to do, what smart money want to do, at least to a considerable percentage of let me say fairness or accuracy. You get it now. So by liquidity, we are simply talking about the volume of money in the market. So the concept of liquidity, we have different types of liquidity. I'm going to speak about them as the time progresses. But in such case, this, you know why we are bullish by structure, according to what we were taught yesterday by our host. We want to only buy from these lows when price retraces. Because yesterday he taught us that we need to mark all the visible highs and visible lows. If you cannot see it, it's not there. We want to mark all the visible highs and not the visible lows. So this is the range high, as he taught yesterday in structure. This is now the range low. I wouldn't need to annotate that. So you are waiting for price to come to the range low and then give you the formation to go higher. That's what you're expecting. Price should come here and you expect price to take you higher. So every other move, all the previous sellers here, previous sellers and all of that, even previous buyers that were here, because people bought this price up, all the previous buyers here are going to be taken out when price retraces back. So this is the concept of liquidity. Now, let's talk about the types of liquidity so that we can make. So liquidity just means money. So it's not a big terminology that you should be scared of. Types of liquidity. Types of liquidity. We have basically we have two forms of liquidity, or we have various forms of liquidity. So by form, we have two types of liquidity by form. By form, we have two types of liquidity. So we have the static liquidity. Let me put it here. By form, we have two types, which are, we have the static liquidity, and then we have the dynamic liquidity. We have static liquidity and dynamic liquidity by form.
No.
It's so frustrating. So sorry. I don't know. Ethel is logging me out when I have that. I don't know why. All right. Is my screen still blur? Is my screen clear?
Low. Just turned low now.
No, it's still blurry.
Is my screen still clear?
Blurry, sir.
It's clear now.
Low.
Like seriously, I don't understand. Ah, I can't.
It's
Okay,
clear now. It's clear now. It's clear now, sir. It's clear now.
sir,
It's clear. It's clear.
it's clear. Okay, okay.
Yes.
It's all right. So let's go to number two, dynamic liquidity. Dynamic liquidity is simply trend line liquidity. That's dynamic. You see price moving and then giving you, let's say something like this. Price tends to respect the trend line. Anytime price comes to it, price bounces off it, goes up, bounces off it, goes up. Price tends to respect that trend line. So when people get in on that trend line, they want to put their stop loss maybe somewhere around here. When they get in, they want to put their stop loss at that low, put their stop loss at that low on the trend line. And when price is going to come back to the trend line, most of the times price will break the trend line a bit and then go higher, violating the stop loss that is placed on the trend line. So this is simply dynamic liquidity. So by form, we have static liquidity, liquidity built around a zone like buy side, sell side, and all of that. Then by structure, we have internal liquidity. I think this is the areas I'm going to dwell on, but let's look at this buy side liquidity first. Let's look at buy side liquidity first. Let's look at a sample. All right, let's go to Boom 500. Let's go to Boom 500. You clearly see how price tends to stay at a zone for long. Many of us, we saw how price was staying within this zone. You can see that zone. It took time before price left that zone. Price kept coming to that zone and price refused to break that zone for a very long time. That was the zone. So let me go to 4 hours so that you see it clearer. So this is what you can find. This was all liquidities that were building up. Liquidities that were building up. This is static. Price came to that place. Remember, this is 4 hours. If I go to 1 hour, you see a lot of wicks in that zone. Price came, touched it, came back, couldn't break it. Price came back the second time, couldn't break it, retraces. Price came back the third time, retraces, fourth and fifth time. Price kept coming there. And the next time price would come, price broke that zone. That was the zone. Price broke it. Now the question is, why did this candle wick up? You can see that candle wick up powerfully, took out all the stop losses that were resting in this zone. All the stop losses in this zone, price came, cleared all the stop losses, all of them. All the people that were buying, selling from all these sides. So this candle came, cleared them and ran down. All the people buying around these zones, all these zones we also cleared. These are the sell side liquidities. Sell side liquidity. You saw how price kept coming to this region countless times, and price sold to take everybody out and went back up. So this is an example of static liquidity. Price is just within that zone continuously for as long as price wants. Let's go to 25. We have all of these things littered on the chart everywhere. All right, this is 25. What can you find? You can see how this zone, because this is a support zone. Sorry, this is resistance zone. You see how the price came here previously? Price couldn't break it. Price came down. Price came here multiple times, like multiple times. See all those rejection candles. Price came here. So everybody that was selling here had their stop losses around these zones, all around these zones. Some had already taken profit and at break even, took some profit. Look at that week. So those that were selling here were right. Those that were selling here were right. But look at what price did. People were buying here. They were actually right to an extent. Because price came here, bought up, came again, bought up. More buyers entered. Price came down. More buyers kept entering on this level, trying to break. More sellers were here. Now look at what price did. Smart money used this candle, took out everybody, rallied down, took out all the stop losses that were also below. This is the concept of liquidity. So when you see, I'm going to come to entry. I'll come to entry. So when you see trades like this and price kept respecting that structure, in the smart traders family, what we do is I want to wait for all this to be cleared. Then we are looking for entry techniques. We want to wait for all these lows to be cleared, all these previous buyers to be taken out of the market. Then we can now get an entry from here. So we'll come to entry, we'll talk about that. Then dynamic liquidity is liquidity built around the trend line. Let me go to the 1 hour so that we see. You can see trend line perfectly forming here. You can see that trend line. First touch, second touch. What can you find? First touch, that was the first touch. People started selling. Confirmation of the sell was when price came here. So more sellers came here on this touch. Then people wanted to come and sell from this touch. You can see how the price came, cleared everybody, and price still sold. All the sellers, were they right? They were right. But liquidity price needed to clear all the stop losses resting around this zone. Somebody selling here, we have the stop loss around this place. Somebody that want to sell here, we have the stop loss around this zone. So price needed to take all that money out of the market, and then price actually sold. So if you see trend line forming like this, we want to see the trend line taken out of the market. Then we look for our entry model. There's an entry model that I'm going to talk about now. So let's go to, by structure, we have two types of liquidity: internal and external liquidity. Now, as the host, Mr. Ezra, was teaching us on structure yesterday, he talks about top range and the low range. So in a bullish momentum, the low is the low range, the last structural low, the last structural point. Why the highest point before the reversal becomes the top range or the range high is the same thing, top range or the range high. So this range high, when price is bullish, immediately price is retracing. This range high becomes your external liquidity. This range high becomes your external liquidity. Let me put it like this. This range high will now turn to external liquidity. What does it mean? It means liquidity to be taken. So we target this range high as liquidity to be taken. This becomes the liquidity that you're expected to take when you enter a buy from here. So as you enter a buy from here, you want to hold price to this level because this is liquidity to be taken as profit, as target. Then internal liquidity is the liquidity that your price is going to be attracted to before entry. I'll take you to the chart. Price is going to be attracted to before entry. More of these videos or a comprehensive courses on this topic are already in our host YouTube channel, so you can check them out. So you see price coming, and then price gives you this low, goes up. This lower high was not mitigated. The bank candle here or institutional candle here or the other block was not mitigated, so price goes up. Now when price is coming, price will take this as internal liquidity. Don't mistake this for break of structure, please. Because some persons will say, okay, this is break of structure. Price has given us a high, a low, higher high, lower low. So when price is coming back, they're waiting to sell around this zone. That's not yet a break of structure. The structural point was here. The range low was here. So price will come and take this out because this was just internal liquidity. Now let me push this. Let me send this out first, then push it up so that we can have I want to give you maybe another sample. Okay. All right, let me give you another sample. Internal liquidity, let me push down, and external liquidity. I'll come back to that page. So watch, price is bullish, and then price gives you this. Price gives you this high. Price gives you this low, gives you maybe something like this, and then price goes up. Then price comes down. Okay, let me leave this here first. Now you are going to, if this candle is here, there is high possibility you take this as a low, as a high, as a low, as a high. Yes, there's every possibility you will take it like that. But price need to take internal liquidity before mitigating this block here. This block. There's an order block here or an institutional candle price is coming to. So price comes and give you something like this, pushes down to this level. Immediately price has taken this liquidity and comes to this place. That is when you want to start looking for your model, the break of structure and the retest. This is our entry model. Liquidity sweep, break of structure, and then retest. This is our model. Never forget it. This is the model we all trade. Liquidity sweep, then price will come, break structure, and then price will come back to retest. Price will give you a high, a low, a high, a lower low, and price close above this last structural point. You take this, there must be this liquidity sweep, break of structure, and price comes back down. Then you want to enter from this retest. So once this has been taken out, that is when you want to start looking for that model around this zone. You want to look for that model around this zone before you want to get your entry. Price will give you this model. You must be able to spot it out. It's when you're able to spot it out that you can start taking trades on the market. That's when you can be able to take clean trades. You want to spot this model any day, anytime. So once you get your entry here, this last range high becomes your external liquidity, which will now be your profit. So if I enter here, open up this candle, my stop loss is now here. I want to hold the trade to this level. So in the advent that price will come and give you this formation. Now I said you want to hold your trade to this level. I'm giving you a real market scenario. Price, don't assume that price is just going to blast through like this. No, price will reach somewhere like this. Maybe price will give you a push up like this, make this, go up, and break this low. Now, once price break this low, this is not yet a break of structure. You know why? Because we are bullish. So you don't want to look for sell entry. We are bullish. You want to keep looking for buys. So immediately you see this kind of a formation, the next thing price is going to give to you is that price will come and give you possibly something like this. Price will come, give you something like this. the same model. Price will give you that model. Price will give you that model to capture the highs. So immediately price gives you this model, then you can get in and take your second position. Price comes, give you that sweep of liquidity, and then breaks above. This is what you are waiting for. This is the correct entry. This is not the correct entry. Don't wait here and say, okay, let me sell down. Maybe price is going to sell and break this low. So long we are bullish and you are on the lower high, you want to take price from here. You want to take price from here all the way to this end. So you want to keep adding position to this end. Let's go to the chart so that I don't bore you with plenty Turenchi. All right, I think you can see my chart. Let's go to daily. Let me start from daily. All right, this is daily, this is VIX 25. This is VIX 25. Clearly on this daily momentum, you can see how that price is bullish. You can see how that price is bullish. Price keeps going high. It's very clear. So we all agree that this is bullish. So if I want to label structure that were taught yesterday, I would say this is my last low. Or let me do it the way our boss did it yesterday. You want to just take all the lows that are visible, all the highs that are visible, take all the lows that are visible. Please just bear with me. I'm going somewhere. Take all the highs that are visible. This is how he did it yesterday for us. So let's flow in that order. So we see clearly that price is bullish. Now that we agree price is bullish, I'm not going to go to that history. I want to go to where price currently is. Yes, where price currently is. You see another range high, and then where price currently is, range high, and then I can't take this as my range low because a higher high has not been formed. So this is still the last range low to the range high. Now, watch what price did. Let me zoom out. We know price is bullish. What can you find here? This is liquidity sweep. You will see this candle closed above. If I zoom out very well, this candle closed above. So I'll take this as my liquidity sweep. Then I'll take this as my break of structure, which is wrong. Which is wrong. Remember, we are still bullish, which is wrong. But remember, we still have all of this push down. This was the candle. This was the whole move down. This was the last push down that resulted to this upward move. You can see that how the price came and cleared all of this liquidity, all these previous buyers that were here. Price came with that wick, cleared them off. This massive buy down cleared them up, and price rallied up. Now, when price rallied up, what can you find? Price created a fair value gap here, an imbalance. Why this imbalance? It's simply telling you that I am attracted to this zone. I have pending orders, unclosed orders in this zone. Volumes were injected in this candle that made this candle to be without wicks to both sides. So price will want to come and mitigate out of that position. So what did price do? Price needed to come back to this zone. Now that price has come to this zone, price has come to the candle. This is the whole candle. 1, 2, 3, 4. This is the whole candle, the whole move. Because like on weekly now, this might just be one candle. But on daily, we have it 1, 2, 3, 4 candles. So price came back to that candle, traded into about 50% of the imbalance here. 50% of this imbalance was traded into. And then price started pushing up. While people are waiting to sell from here, a smart trader will know that we are still bullish. So you'll be looking for buy entries around this zone as price came to the imbalance. I'm talking about entry now. Entry formation. That's what I'm talking about now. What's your entry formation? Our entry formation, we want to wait for price to come to this zone, either the order block or the imbalances, fair value gap or IPA, and you want to wait for that formation. What's the formation? A break of structure to the upside, and then we go. So let's go to 1 hour. Let's see if we had something like that in this zone. Let's see if we had any push up. Remember, there must be a break of structure in that zone. So watch what happened as price was coming. Price gave us, look at it, this low, produced this high. Price gave this low, gave this high, gave this low. Price gave, okay, price didn't close above. This was the break of structure. Now, if you watch, these candles didn't close above this candle. So this was the last high that created this low. So this is just one leg, and this was the break of structure. So price has given us that break of structure here on the 1 hour, a break of structure here. So what are we expecting? We're expecting that price will definitely trade back into this place, into this zone. Price should trade back into this zone. Now, what did price do first? Price came into this zone. There was an imbalance here. Price traded into this imbalance. Price didn't touch the last candle. Price traded into this imbalance and gave us a higher high. This is still my ranges. This is still my range low. This is still the range low. This is the range high. Remember, I want to look for entry, our entry formation. Now, immediately price started tracing back. You start looking at, okay, are there any gaps or imbalance below? Because for entry, we majorly use the mitigation candle or order block for entry, imbalance for entry. That's our entry techniques. Either we use order block or we use the imbalances. So order block is what we're looking at on the daily. Now we've come to a lower time frame like the 1 hour. The imbalance was left in this place. So look at the imbalance. Actually started from here, and that was the imbalance. I just hope you can see it. Price traded to the 50%, gave you a high. And we expect price to keep going up. But what did price do? Let me remove this here. Price came, made this liquidity, cleared it, and price gave us a formation on a much lower time frame. So this became my internal liquidity. Why? Because there was still imbalance. There was still a gap that was left below. There was still a gap that was left below that price needed to close. That was where price came to. Price had to come back to that gap. There is no, the market must be balanced. So there must be equal at a time prices for both buyers and sellers. So price needed to come back. This became internal liquidity, and then price filled that IPA, price retraced. Immediately price filled that IPA, I saw this break of structure here. Remember, we want to keep buying. So I'm not going to look at all of these that you see here, that price came, and then you call this a high, a low, broke structure, and price started selling. So as price was coming here, you want to start selling. No, it doesn't work that way. You are trading wrongly. We are bullish on the daily. So I'm looking for every break of structure to the upside, and then I'll play. What can you find? Price came, and price closed above this candle. Look at this candle. This move went, closed above. So when this move closed above, watch what price did. Price gave you a double bottom. Look at it. This was a double bottom. Price touched here, went higher. Price came back, touched here, and you'll be expecting that price will come and close above. When I saw that price couldn't break and price started coming down, I knew this was internal liquidity again. So I waited for this liquidity to be taken away, and then I got in on the sweep of the liquidity, the sweep. So price took this liquidity out, and that was the entry. I played the sweep, the close of that liquidity. Immediately this was swept out. That was my entry. Stop loss here. That's the best entry. And then I'm looking at this range high as my first target. It took time, but price came there, giving a 1 to 4. And then look at what price kept doing since then. Price kept breaking off this range, breaking off this range, breaking off this range. Price broke this static liquidity around this zone, traded into this imbalance. Remember, price will want to fill all the imbalances. This was the fill of the imbalance. Because once price start going up, price will not want to look back. Remember, we're bullish. So price saw this imbalance. That was another entry. But I'm not going to just come and enter here while I'm expecting to, where will I put my stop loss? There's no structural point to put my stop loss. So I want to see another formation around this place. So this is another zone that if price break, look at that zone. You see high, low, high, and then this was the low. So if candle closes above here, I know price will come, take all these ones as internal liquidity and will go up. So entry, our entry model is imbalances, fair value